how early or late are we in this cycle? Well, you can see that this is the normal cycle, the dotted black line. The low point is the trough of the cycle, and the red line is where we are now. So this looks late. I mean, we've got to accept that. We're late in the cycle. It doesn't mean it's about to end, but we've got to know we're nearer the end than we are at the beginning, and that's clearly an important factor. Now,
when do you think it finishes? By the way, my view is it's been extended. It normally would have finished sometime this end of this year, but it feels like it's going to push out into Q2 next year.
Yeah, I mean, that's almost exactly where, if I go back to looking at this cycle, that's where we would sort of suggest it's probably going to inflect sometime around about early 2026.
Markets move in cycles, and Raoul Pal with Michael Howell believe we're in the late stage of the current liquidity cycle. While AI investments and debt refinancing could keep it alive into 2026, inflation risks are building. This time, liquidity rather than business activity is driving prices. Treasury flows and policy moves are fueling markets even as traditional indicators stay flat. For investors, assets like equities, gold, and crypto may keep thriving, but late cycles often bring sharp pullback. Staying exposed while managing risk is key.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
Let's start with the global liquidity picture at top level, where we are from your framework, where we are from your understanding, and then we'll dig in some of the regional stuff because there's lots of interesting things going on. I read your note this morning about Japan. I think that's interesting as well. So at top level, where are we in the liquidity cycle? What are you seeing?
Well, the answer is we're late. It's not inflecting downwards yet. We're still in an upswing. But, we've got to remember here that the liquidity cycle is, 34 months old. That's pretty mature. As things go, we got to be thinking of what could be the end game. I don't think there's anything on the horizon that could necessarily disrupt things, but, there are clearly problems building. And I think, as we look into 2026 and probably beyond, I mean, there are factors to think about. And to my mind, I mean, the two biggest factors, number one is that there's a lot of debt that's got to be refinanced out there because debt was effectively termed out during the COVID crisis, large amounts when interest rates were zero. And that's coming back into markets to be refinanced really from sort of later this year, but through 26, 27. And the other thing we must, remember is that, strong economies don't always have strong financial markets. And the fact is that you've got US tech companies currently investing, $1 billion a day in IT and infrastructure. And, over the course of a year or so, a couple of years, that's going to take about $1 trillion out of markets, out of money markets. I mean, these are big amounts. So these companies may be seeing decent profits growth, but their cash flows are really plunging. And that's got to be a problem, for financial markets, in particular.
So let's dig in a little bit to the slowness of this cycle versus others. From our work is like, normally the liquidity cycle peaks around the business cycle peak. They're all, related. And the business cycle has been super low. If you look at the ISM, it's been below 50. And the strongest correlation to that is rates have been too high for too long. And that has kept the ISM lower than expected, which means it feels like it's elongated the liquidity cycle. So that's one factor that I'm looking at. The other one is the fact that they've been shoving everything into the bills market and not refining, in, let's say, the 5-year sector, that's kept this, cyclicality. And I don't know if that structure is changing things because it requires ongoing liquidity as opposed to cyclical liquidity. So firstly, the business cycle and interest rates, and then, whether the structure of where they've been issuing makes a difference.
Yeah. Well, I think the first thing is we don't seem to have a business cycle. And if you look at almost any economy since the COVID crisis, everything's kind of flatlined. So there's no obvious business cycle around. And, we can conjecture as to why that may be. Is it because fiscal policy is dominant? Whatever. But the fact is that there's none. There is a liquidity cycle, and that seems to be paramount. And the interesting point is, which I'm sure you'll attest, is that, financial markets are responded not to the real economy, they're responded to the liquidity cycle. That's what's going on. So we need to understand this, like it or not. I mean, it's become the paramount issue in markets as far as we can see. So I think that's true. And I think your point that about bill issuance is really critical. And, the way that we've sort of, I suppose, explained this before is to say what you're getting is a transition crudely from Fed QE to Treasury QE. And the Treasury are basically coming in and issuing a lot of bills. They're starving the market of long-dated coupons. So there's not the liquidity absorption that you would expect. People are being forced into the short end. Two things really come from that. I mean, one is that there is lower volatility in markets as a result. And in fact, we know the Treasury is very keen to actually keep volatility down, given the way they've upped these buyback programs. So that's significant. And if you get a lot of bill issuance and short-dated note issuance, the banks buy it with alacrity, because this is the sort of security the banks like that matches deposit growth. And if the banks are doing that, they're effectively monetizing the deficit. So I think that's the route to a trend increase in liquidity over the medium term. We know governments basically have to find ways to fund themselves. And what better through this mechanism?
And do you think that this stops them issuing at the longer end? Or is it just a delayed process until they can get rates lower? And we'll come into that in a little bit. But is this a structural change that's going to ongoing? And because it's bills, that feels like ongoing stimulus, and it might change this whole cycle.
Well, I think the answer is that it continues until it doesn't. And the fact is, we know that these things always end badly because they tend to end in inflation. And that's the experience we've had in the 1970s. So it's going to go on as long as it does. And then it will be forced to stop, presumably, by concerns over an inflation pickup. Now, I think everything they're doing is trying to bury that inflation news by whatever means, fair means or foul. So we're never too sure what the inflation rate is. And I'm always, instructed by the fact that, one's personal inflation rate is always way, way above what you read in the CPI. So there's obviously a lot of manipulation going on anyway. But the fact is you've got inflating asset markets, which is really attesting to the fact that you've got strong monetary inflation. And monetary inflation is not just a cycle, as we know, it's a trend. And that trend is accelerating. And I think what the world doesn't realize is that things have changed dramatically since COVID. We're in a world of monetary inflation, monetary debasement. It's not, as I keep stressing, it's not one of financial repression. It's one actually more, it's worse than that. It's actually monetary inflation. And you've got to start thinking about how to invest in a monetary inflation world.
Yeah. And, and both of our hypotheses is, long duration assets tend to do very well in that environment. And we've seen that with technology stocks and crypto. Gold has acted very well in this environment, as it should do. And, all the signs are there that the debasement is ongoing and it's not going to go away. One of the things that is interesting to me is obviously Trump and Bessent are focused on what they can do with the Federal Reserve. The shenanigans around changing the governor and various board members. Clearly, they want to see if they can force interest rates lower. I think personally interest rates are too high versus GDP or, whatever your kind of real interest rate measure you look at, and that there's room for rates to come down 200 basis points, which allows them to refinance.
Raoul Pal and Michael Howell see markets in a late liquidity cycle, fueled by debt flows and AI investment, but warn inflation risk is rising. Assets like stocks, gold, and crypto may benefit, yet late cycles are volatile, making risk management essential.
Any thoughts on the kind of Fed board shenanigans?
Yeah, I mean, I'm cynical enough not to think it really matters too much. I mean, at the end of the day, I don't think the Federal Reserve really controls interest rates, certainly across the curve. I mean, it's rather the other way around. Long-term rates tend to drive the Fed rather than vice versa. So, ultimately you've got to say, well, okay, what's the fair value for the long-term bond? And that has to be related to nominal GDP growth ultimately. So you're talking of something like about 5%. and then you take what is a normal spread between the short end and the long end. What is it? 125 basis points. So that gives you your benchmark for Fed funds. So there's not much they can do sort of either side of that. And they can dance on the head of a pin and come out with their projections. But in reality, the FOMC doesn't have that much sway, I don't think. It's really a signaling tool more than anything else, as far as I can see. What matters more is really the balance sheet, what they're doing there.
Yeah, I mean, although the other side of this is we're all kind of expecting yield curve control in some way, shape or form at some point, just because of the debt refinancing mechanism. And one of the things is interesting is, and I only read about this morning, that there is some changes in the Federal Reserve Act that may allow them not to pay interest on bank reserves, which would force it into the bond market. That feels like, a backhanded way of yield curve control by forcing banks to go further out the curve. Does that factor in at all?
Yeah, it could be. I mean, I think there's a lot of it, all these things that they're lining up, whether it be elimination of the SLR, the supplementary liquidity ratio, whether it's changing stress test rules, all these things are really trying to give the banks more capacity to buy government debt. And we know ultimately this is what tends to happen in a monetary inflation. Banks tend to come in and buy government bonds, then monetize the deficit. And that's the route to funding. The question is, how quickly are we going to get there? Or how quickly we get there and inflation really becomes the issue. I think they can probably push inflation down over the longer term. And I think there's a lot of factors in there in the equation, as you will know, things like AI, which are probably going to depress consumer prices. But at the end of the day, what makes all this very confusing in a way is that high street inflation is very different from monetary inflation. And you can have a background of strong monetary inflation, but because you get, cost deflation, in other words, productivity wins or cheap Chinese goods, the high street's less affected for some time. And ultimately, investors have got to invest around monetary inflation, the debasement of the currency, much more than what they're seeing in the high street. But it will come through in the high street at some stage.
Yeah, and it usually comes up as the business cycle picks up as well, if it does pick up, which I think it does. The other thing that's been interesting to me is the shift in how the Fed and the Treasury have kind of managed the debasement. It started simply with the balance sheet. Then everyone kind of figured out that game, and then it turned into this Fed net liquidity game. And now it's gone to what we look as a total liquidity, which is including the private sector, because they're now using the banks as their main mechanism of debt monetization. Does that make sense to you?
Makes complete sense. Absolutely. I mean, I can put up some charts if you want me to.
Yeah, go.
So in terms of where are we in the cycle, this is our liquidity cycle, which goes right back to the 1960s. And the sine wave there is something that we fitted back about 20 years ago in the year 2000 to show you've got this 5 to 6 year cycle, which is, I think, different to the way that you see it in terms of a 4-year cycle. But this is based on an analysis of this liquidity data. Now, how early or late are we in this cycle? Well, you can see that this is the normal cycle, the dotted black line. The low point is the trough of the cycle, and the red line is where we are now. So this looks late. I mean, we've got to accept that. We're late in the cycle. It doesn't mean it's about to end, but we've got to know we're nearer the end than we are at the beginning, and that's clearly an important factor. Now,
when do you think it finishes? By the way, my view is it's been extended. It normally would have finished sometime this end of this year, but it feels like it's going to push out into Q2 next year.
Yeah, I mean, that's almost exactly where, if I go back to looking at this cycle, that's where we would sort of suggest it's probably going to inflect sometime around about early 2026, thereabouts. Now, this chart is the one I use as a parallel to say, is there a similar cycle that you can think of? And I think back to the 80s as maybe being the benchmark, rightly or wrongly. You had the Plaza Accord, ditto the Mar-a-Lago Accord. You had rising inflation. You had bond markets, yields edging up. You had commodity prices beginning to boom. And then you had the crash, which was pretty much triggered. I'm old enough to remember it, but it was triggered by the Germans saying they were thinking about raising interest rates, which spooked Treasury Secretary Baker at the time, because the US were really angling for lower rates, now. And then, the proverbial, SH1T hit the fan, and market, investors realized that the liquidity cycle was about to reverse. And that's what happened. Now, we could easily be, as this diagram says, a good 6 months away from that. So, watch this space, but we got to be alert to those factors. Now, to come to your point about, and I can always come back to these charts, what's happening in terms of the treasury. This is what we reckon is going on in terms of the sources of monetary stimulus in the system. And what this diagram breaks down is 3 different categories. One is conventional plain vanilla QE, which is, using the SOMA account at the Fed, in other words, expanding the balance sheet to stimulate, which they clearly did a lot of in COVID, and that's the red area. You've also got, if you like, the backdoor stimulus, which is what we loosely or flippantly call not QE, which is the hidden QE, which is things like the Treasury General Account, the Bank Term Funding Program, the losses they're making on interest payments to the banks, and the reverse repo program rundown. That's the orange bit. Now you see those things are kind of exhausted. I mean, they can revive if they decide to change from QT again to QE, but at the moment they're spent. And then what you've got is the black area, which is what we call Treasury QE. And that really comes by shifting the duration of issuance from longer dated debt to shorter dated instruments. And the reason that's important is that, very crudely, we tend to think that liquidity is equal to an asset divided by its duration. So if you're reducing the average duration or maturity of assets out there in the private sector, you must by definition be improving liquidity. And the black area is the impact of this big issuance or wave of issuance of bills and short dated debt, through the Treasury calendar, as opposed to coupons. So you can see it's becoming material. There's a little bit of a lull right now in terms of that stimulus, which may explain why the economy is soft, but it does pick up. And that's why this is a critical point.
Raoul Pal and Michael Howell see markets in a late liquidity cycle, fueled by debt flows and AI investment. While this could extend gains into 2026, rising inflation risks may cut it short. Assets like stocks, gold, and crypto can still benefit, but volatility is likely. Investors should stay positioned for growth while managing risk. Do you think this cycle can hold up until 2026? Which asset, stocks, gold, or crypto will lead the way? Let us know in the comments.